Have you ever wondered how to invest your money wisely and build wealth for the future? Even if you're new to investing, you've probably heard of index funds. But what are they, and how can they help you achieve your financial goals? In this video, we're going to dive deep into the world of index funds, explore how they work, compare them with other investment options, and discuss whether they should be a part of your investment strategy. Welcome back to the Daily Decode. So if you want to secure your financial future, stay tuned because we've got the solution for you. What is an index fund? Let's start at the beginning. What exactly is an index fund, and how does it work? Well, an index fund is a unique investment vehicle designed to track a specific market index. Instead of investing in individual stocks, an index fund offers a diversified portfolio of stocks, bonds, and other securities, making it less volatile and more stable. But what sets them apart is that they're passively managed, meaning they follow the index's performance rather than relying on a fund manager's active decisions. To recap, index funds are popular for a reason. They're low cost, diversified, and follow a market index. But of course, they're not without their risks. How does an index fund work? Index funds are all about passive investing. Unlike mutual funds where a manager actively selects securities, index funds simply mirror the performance of a particular market index. These indexes, such as the S&P 500 or the Dow Jones Industrial Average, have their own methodologies for selecting their components. While you can't invest directly in an index, there are funds that allow you to invest in the index's performance. To give you a real-world example, consider the Fidelity Total Market Index Fund, which tracks the Dow Jones U.S. Total Stock Market Index. It owns roughly 4,000 stocks and boasts a super low expense ratio of just 0.015%. With index funds, tracking an established index minimizes the effort and costs associated with actively managed funds. Types of index funds. Now it's not just about the S&P 500 or the Dow Jones. There are countless index funds out there covering various segments of the market, from broad market stock and bond funds to niche sectors, industries, and even alternative investments. The world of index funds is diverse and continually expanding. Do index funds pay dividends? Well, it depends on the index they track. Index funds that follow dividend-paying indexes, like the S&P 500, do pay dividends. These dividends are usually distributed quarterly or annually. And for those long-term investors who don't need immediate income, many index funds also offer automatic reinvestment of dividends. What fees do index funds have? Let's talk about fees. Understanding the costs associated with index funds is crucial. The primary fee to consider is the expense ratio, which covers most of the fund's costs. However, ETFs, which are also a type of index fund, may have transaction fees when buying. More complex indexes may have higher expense ratios, so it's essential to weigh the cost against the complexity of the fund. Index funds, benefits and risks. Now let's explore the benefits and risks of investing in index funds. Many investors choose index funds because they are considered a safe investment. However, it's important to remember that their success depends on the index they track. The benefits include low fees, a diversified portfolio, and a straightforward, hands-off approach to long-term investing. They also offer better tax efficiency. But like any investment, index funds come with their own set of risks, such as inaccurate tracking, uncertain performance in extreme market conditions, and increased governance risk due to their passive nature. How do index funds differ from stocks? One question you might have is, how do index funds differ from stocks? When you invest in individual stocks, you're buying ownership in a specific company, which can be more volatile. Index funds, on the other hand, offer diversification and are less dependent on the performance of a single company. This difference significantly impacts the level of risk associated with your investment. Is an ETF an index fund? So are exchange-traded funds, ETFs, considered index funds? Most ETFs are indeed index funds, but the rise of active ETFs is changing the landscape. Active ETFs have managers making investment decisions independently of an index's rules. These are generally preferred by investors who want to be more actively involved, while index funds are favored by those seeking a passive, long-term investment strategy. Index funds versus mutual funds. To better understand index funds, let's compare them with mutual funds. Both are investment vehicles, but they have distinct differences. Mutual funds can be actively or passively managed and involve a variety of investments. In contrast, index funds, like mutual funds, are passively managed, offering lower risk and lower costs. The choice between the two depends on your investment goals and preferences. Are index funds good long-term investments? Well, for long-term investors looking for low-cost diversification and transparency, index funds can be a valuable part of your strategy. However, if you're after quick, large gains, your choice of index funds becomes critical. You may need to invest tactically in a set of ETFs to profit from short-term market movements. Remember, there's no one-size-fits-all answer, and it's essential to align your investment strategy with your financial goals. In conclusion, index funds are an excellent way to start or enhance your investment journey. They offer a straightforward, cost-effective, and diversified approach to long-term wealth building. However, like any investment, you need to do your homework and personalize your strategy to balance reward and risk. With the right knowledge and a well-thought-out investment plan, you can secure your financial future and achieve your goals. Thanks for joining us in this exploration of index funds. If you found this video helpful, please like, share, and subscribe for more financial wisdom. Happy investing!